just in case they are a new investor, maybe they've never worked with us before, we'll put our track record and any of our partners' track records at the back of the book, just so, first, let's get you comfortable with the returns. Let's get you comfortable with the business plan. And now let's get you comfortable with the sponsor. Because if you don't trust the sponsor, the business plan can be the best thing you've ever seen, but you're not going to invest.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 384. My guest today got his start in real estate as a broker for Marcus Millichap in Raleigh, North Carolina, before starting his own real estate firm with his twin brother. Will Matheson went from 0 to 100 million in assets under management in just 4 years, and he's done it through multifamily and student housing investments. Today, we'll take a closer look at student housing and compare it to multifamily and learn how Matheson Capital plans to achieve their goal of $1 billion in real estate by 2027. Will, welcome to the show.
Thank you for having me.
Tell us a little bit about your background and how you got started, not just at Marcus Millichap, which I know you spent some time there, but also investing in real estate.
For us, real estate, it really is a family business. My mom was a residential real estate agent, but the rest of her family has all been involved in real estate. A lot of them work at CBRE in Canada as brokers or on various other sides of that industry. So when my brother and I were leaving college, we knew we wanted to get into brokerage, and we ended up at Marcus Millichap in Raleigh, North Carolina. But after doing that for a few years, we decided that we really wanted to be more on the ownership side. So after a couple of years in brokerage, we decided we really wanted to do more on the ownership side, and we left Marcus Millichap and we went to Columbia University's Master's in Real Estate Development program. It's a 1-year program. I highly recommend it. Meet a lot of great people in the industry there. And leaving that program, I want to say is the end of 2017, we graduated in spring 2018. We were thinking to ourselves, what do we want to do? We can either go, the 9-to-5 route, corporate job, and try to climb the corporate ladder for the next 15, 20 years, whatever you want to call it, or we can go out on our own and try to start our own company. And that's what we opted to do. We worked on our first acquisition while still in school, as a 2-unit acquisition in Los Angeles. We did another acquisition May of that year, also in Los Angeles. And ever since then, we've done about 11 acquisitions in the Carolinas.
One of the unique things about you is you have a twin brother, and you're both doing the exact same thing in the world of real estate, and you run Matheson Capital together. So I have to ask, what's it like having a twin brother? Does that give you an edge in this space, or does that create a lot of confusion?
It hasn't created so much confusion. Fortunately, we don't share, a first name, so that would have made things a little more difficult. But I'll honestly say it's pretty great working. I've essentially had a built-in partner my entire life. So we've been together. We went to school together, except for college. We worked together at Marcus Millichap. We work together now. He actually typically sits on the other end of this office from me. Not right now, obviously, because we're recording, but it's been really great. Couldn't find a better partner.
How do you complement each other? I mean, do you find yourselves both doing the same thing, or are you better at one thing and he's better at something else?
Very early on, we decided that we were going to segment what we did so as not to be doing, the same work. So Evan has always been just an incredible financial modeler. Every company he's ever been at, he's seemingly rewritten their financial models, or sometimes in school, he would actually rewrite the teacher's slides after taking the class and how they could be improved. Very endearing, I know. But he was asked to do it. So he does a lot of the financial analysis, market analysis type stuff. I deal with a lot of the legal. I deal with a lot of the strategic. I deal a lot with the brokers. So I guess you could say he does a lot more of the math and I do a lot more of the talking. Hence why I'm here.
Tell me what you learned at Marcus and Millichap, because if you were on the broker side, I'm sure you got insight into the space that probably does give you an edge over other people who are trying to acquire properties.
It was definitely helpful working at Marcus and Millichap just for the purposes of all you would do every day is look at real estate and analyze real estate. And not only, if you had a client looking to buy a property, you might take a look at that for them doing, checking their assumptions, checking their analysis. But I mean, so often as with brokerage, you're looking at the sale, you're looking at how to value the property for the sale. So, when it came time to buy, obviously, as opposed to coming from an accounting background or any other number of backgrounds, we had been versed in real estate, 7 days a week doing that. And then I think it gave us a lot of credibility with investors, but also just this is how you analyze the front end, this is how you analyze the back end. And that just left us to learn more about the middle, the ownership portion. The analysis, the acquisitions, the dispositions, all of that was really helped by brokerage.
So, Will, coming from the brokerage side, did that give you insight that helped you with your first acquisition? And what was your first acquisition?
It definitely helped in terms of, I would say, the confidence to move forward with that first acquisition. Now, since we were brokering in the Carolinas and our first acquisition was in Los Angeles, it didn't help us there. That was actually brought to us by a classmate at Columbia. But, our first two acquisitions, they were brought to us. But after that point, when we said, hey, enough of California, like so many people have said, we're going to focus on the Carolinas. Let's get down here. Let's go full bore on the Carolinas. That really helped us being a broker in terms of building rapport with brokers, talking to them, understanding what they were looking for in buyers, understanding how to make us, present ourselves in the most appealing ways. Because we'd sat through the process of having multiple offers on properties, screening out who we thought the most qualified buyer was, who gave us the highest probability of close. And that really helped us in that respect.
What are some of the clues or the insights you look for if you're looking at say 5 buyers who all have decent offers in on a property? What helps you narrow them down?
You want to look at track record. You want to look at, lending relationships historically. I've been in situations in our current spot where we have a great relationship lender, First Carolina Bank, and we actually went into an LOI one time. Like we submitted an LOI with a loan term sheet, and that put us over the top on an acquisition. Whereas other groups, they'll say, hey, look, I need to figure all this out. I'm working with a new mortgage broker. Obviously, another side of that is equity. Where's the equity coming from? Is this group going to raise all the equity? Do they have control of the equity? Are they demanding seller financing? So past execution, where's the debt coming from? Where's the equity coming from? All of those, are they out of state? Have they even seen the property, which happens fairly frequently? People put in offers, they've never seen the property. So all of those play a factor.
Talk us through your first acquisition. What did you buy? It was in Raleigh, I'm hearing you say. What was it, and how did you take it down?
I'll skip over the first two acquisitions. Those were out in Los Angeles. Our first acquisition in the Carolinas was actually 6 units, 18 beds of student housing in Boone, North Carolina, where Appalachian State is. I use that one as an example because, again, the first two, they were brought to us by a friend of ours, and they were reasonably simple transactions. But this one, we're like, this is where we're going to really build our portfolio and build out everything with Matheson Capital. So that property was actually brought to me by our former, I guess you would say, my former boss at Marcus Millichap brought us that property. He said, hey, look, it's small. It's $915,000, but we really like it. We think there's management upside. We think there's renovation upside. So we said, yeah, let's go. We put in an offer. We did a little negotiating. And I look back at it now, and the original investment memo we gave to investors it's missing a lot of stuff we include now. It's funny looking back on it, but, to a certain extent, we were just trying to figure out everything as we went, despite all the experience. But yeah, that property, $915,000 acquisition, closed January 2019. about a year after our first Los Angeles acquisition.
So what was it missing? You took it to investors and shared it with them. Are you saying that like the pro forma was missing some inputs?
It was missing a lot of slides. I don't think the market overview was particularly great. I remember looking at it and seeing this return metric, but I don't even think it broke out the annual cash flows, the annual pro formas. Obviously, we had one, but I don't think we had put it in the book. Just one of those things that a month later we corrected for our next acquisition, but it's really funny looking back on.
From that experience, what do you think is necessary to show to investors? Like, what are the metrics you now always share?
Typically, I don't think an investment memo for investors should be any more than 20 pages. Any more than 20, it's just getting a drain. But you want to show them a brief overview of the property. Just these are the basic details. These are the returns I want to get you. Be very upfront about that. It might be a no at that point. Don't make them read 20 pages to say no. If you show them the returns, they say no up front, you've done them a favor. And they've done you a favor in a certain extent. But get the returns out up front, give them the property information. And we go with a very detailed pro forma. Anyone who wants to see our model, we'll send it to them. If we have a CapEx plan, we detail out the full CapEx plan, full market summaries. This is why we like this market. This is what's new in this market. And we'll typically end it with, just in case they are a new investor, maybe they've never worked with us before, we'll put our track record and any of our partners' track records at the back of the book, just so, first, let's get you comfortable with the returns. Let's get you comfortable with the business plan. And now let's get you comfortable with the sponsor. Because if you don't trust the sponsor, the business plan can be the best thing you've ever seen, but you're not going to invest.
Your first acquisition in Raleigh was student housing. Compare that, because you've done traditional apartment, multifamily investing and student housing. I'm really interested on how you would perceive each one and which one you like better.
Student housing, I'm a bigger fan of, depending on the market. With multifamily, population growth is really big. What type of renovations you can do are really big. But student housing, I actually think it's a little more complicated, because not only are you looking at, hey, is this a growth town, but is the university growing? What type of university is it? Is it a public university that's very affordable? Is it a private university that's really expensive? Am I competing? Let's say you look at a property in downtown Raleigh. Am I competing with all of the new construction in Raleigh if I'm trying to house students, or am I only competing with certain new construction, that's right next to the university? So there's a myriad of factors there. I mean, on top of that, is it grad student housing? Is it undergraduate student housing? What are the regulations for students living on versus off campus? What's the on-campus housing supply? So in certain markets, I'm going to really prefer student housing. But if you told me in certain markets, I'll prefer student housing, but multifamily housing, it's a little easier to wrap your head around. I think the analysis is it's slightly easier.
For our listeners who are not familiar with student housing and the differences, what are the differentiators with student housing that separates it from traditional multifamily housing?
The biggest differentiator, I mean, look, they're all buildings, they all have rooms, and people need to stay in them. But the biggest differentiator is the lease cycle. So for a lot of universities, you're going to have essentially one leasing cycle that, in the Southeast at least, it ends at the end of June or July, and it starts at the beginning of August. And you have to turn every single unit, every single bedroom in what can be 2-3 weeks. So it's very management intensive in terms of that. And if you don't have a good management company, you can really get yourself off on a bad foot. You can really be in a bad spot with that. Whereas multifamily, you have leases expiring every month of the year. People come, people go. The big difference, I think, is that everybody leaves at once and everybody comes in at once.
What kind of problems have you had with student housing? Any different type of problems than you would traditional multifamily?
I'll be honest, it might just be because we pick our universities, but I've actually not had, all of my worst problems have been in multifamily. We haven't had terrible problems with student housing. I mean, typically collections aren't a problem if you can get parental guarantees, which you often can. So you get your loss to lease goes down. I mean, even though there is the reputation of students being, more rambunctious and all of these things, they do have security deposits still. It's not hard to figure out who's responsible for any issues like that. The number one challenge people always have with student housing is, what do I do at the end of July and the beginning of August to make sure we get everything ready in time? Because if you do that wrong, then you're in trouble.
Have you done it right every time, or have you ever gotten it wrong?
Yeah, we're very fortunate to work with third-party property managers who are very, very big in those markets. I was joking with someone recently, I would never own or manage student housing, because if you only have, let's say, 50 units of student housing at a university and Graystar is next door to you with 1,000 beds somewhere, who do you think is going to get all the best contractors when it comes time to turn those units? Who are they showing up to first? I want to make sure that I don't want to take any chances on that. So I want a property manager with a big footprint in that market, with great relationships, deep roots, all of that stuff. So I know that during that 2-3 weeks, they're getting everything done, and they've got the relationships to ensure they get everything done.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Is that a high tension couple weeks for you every year? Like, just you're on pins and needles waiting to see if everything's going to get done that needs to get done?
I'll be honest, it hasn't been, because I have full faith in the team we use.
Let's talk about the trajectory of your business, because you went from 0 4 years ago to 100 million in assets under management. Your goal is to get to $1 billion. Tell us how you got to 100 million within 4 years. How did you do that?
As you've guessed, we obviously started very small, with the duplex being our first acquisition. And for the longest time, our primary focus was we need to stay small. We need to focus on small properties, because if we stay with small properties, we know we can raise the equity for it. Because when you buy your first property at 25, shockingly enough, people aren't lining up to give you tens of millions of dollars. So we went with that approach, and we stayed there, and we're buying $2 million, $3 million properties, $7 million properties. And then we had the opportunity to partner with a larger firm on a couple of assets in Boone, North Carolina, $60 million. And we came to them and we said, hey, look, we know this market going back to when we were brokers at Marcus Millichap. We own in this market as well. We think you can employ a few strategies here that could make it more efficient. And we got to work with them on these massive acquisitions. And that not only helped us, but we not only helped them, but it also helped us gain a lot of investors, just people seeing, hey, look, these guys are working on bigger projects. So that was really good. We stayed small, we grew, and when we saw an opportunity to really add value in a partnership, we took it. And that ever since that moment, we've been taking on larger and larger projects.
I'm hearing you say that partnering with larger groups got you to 100 million assets under management. How do you go from 100 million to $1 billion in the next 5 years? Is it more partnerships? I mean, what levers do you pull to get there?
I mean, you've got to be willing to pull every lever. I mean, there's plenty of operators significantly larger than me that are partnering with operators significantly larger than them. We've been really fortunate. As I mentioned, when we first started, equity was always our biggest concern, but we've forged some great equity relationships. We've forged some great co-GP partnerships in the past few years, and we really just plan on building off of those as we move forward. You know, we're looking outside the Carolinas now into Georgia, Tennessee, Virginia. Everyone says Florida. We're looking there as well. So, you know, as long as you're building on those relationships and you keep on pushing forward, it might be joint ventures, it might be you being the solo partner, but you know, you've got to look at it in every way.
Let's talk about the equity relationships you've created. Are you raising funds and equity from individual private investors? Are you doing family office, institutions? How are you raising your money?
We've worked with all of those types of investors. We started out with syndication. You know, you start with the friends and family, and we grew from there. We worked with some family offices, and just this past October, we had the opportunity to work with do our first joint venture with a private equity firm. So we have worked with, you know, let's call them retail investors, high net worth individuals, family offices, and institutional / private equity.
So, Will, when you go to private equity or family offices, you're dealing with a different type of equity investor. What are they looking for in you that makes them say, okay, we're gonna put our trust in Matheson Capital?
I think the number one thing they're looking for is a track record of success. That's another reason we started with small properties and just doing very short-term holds. Most of our holds were less than 2 years, and we did that strategically. One, because we didn't want to go to investors and say, "Hey, look, I'm 26, 27 years old. Commit to me for the next 10 years." We wanted to say, "Hey, we're going to try to get in and out in 2 years, and it's not a long-term commitment. We're going to try to get you a really nice IRR." So we would do that, start, finish. And then, you know, when it was time to look at nicer assets, larger check sizes, not only did we have a pool of happy investors who were ready to reinvest, but we also could show a private equity firm, hey, look, we know what we're doing. We've taken this many projects from start to finish. We've gotten these returns cemented. It's not up in the air. This money has been returned to our investors. So seeing the track record, I think, is the number one thing.
When you work with them, they have a little bit more control, right, than your LP investor, your limited partner investor. What kind of metrics are they looking for in the reporting and, you know, the quarterly reports or the updates that you're providing them?
I mean, they're looking for a lot of the same metrics that any other investor would, but they just, you know, instead of quarterly, we talk to some biweekly. You know, they want reports every 2 weeks as opposed to every quarter or every month. And obviously they have, I don't want to say higher expectations, but different expectations. And they have to sign off on, you know, refinance or sale scenarios. But quite frankly, when you're providing 80 to 90% of the equity, I think it's a legitimate ask.
Tell us again what you see over the next 5 years. I know you're going for $1 billion in assets under management. You seem to have done a good job of bringing in the equity. You've formed relationships and partnerships and teams. But big picture, where do you see yourself 5 years from now?
I mean, I'm certainly hoping to have the $1 billion under management. But I mean, our outlook on apartments is you may see prices go up, you may see prices go down in the short term, but over the long term, as has been the case for the last 50 years, it's not getting any easier to build them. A lot of them keep seemingly being pushed further and further out. As a country, we do not build enough housing on an annual basis, and I think that's been the case for decades. So long term, I think the fundamentals are great as long as you're investing in, you know, high growth states such as the Southeast.
Tell us as we wrap up here, Will, what is your favorite hack or app?
My favorite app is probably Todoist. It's just, I mean, it is what it sounds like. It's just a to-do list. You can set it all sorts of ways, daily reminders, just one-off tasks. I typically try to check off, I don't know, 10 to 20 to-do list items every day. great way to stay focused, and also track your progress in terms of what you're accomplishing throughout the day. So that's probably my favorite app. Not a very glamorous one, but very results driven.
And that's Todoist, Todoist.
That's correct.
Tell our listeners how they can find out more about you or get a hold of you.
So I'm very easy to find on LinkedIn, just Will Matheson Capital, Charleston, South Carolina, whatever helps you with that. And there's also our website, mathcap.com, obviously, mathcap.com.
Will, thanks so much for coming on the show. I really appreciate your perspective as a former broker for Marcus Millichap, and then just your insight into student housing and multifamily and apartments. And I've appreciated everything you had to say about working with private equity groups or family offices. Thank you so much for coming on the show. I've enjoyed this conversation.
Thank you, Brian.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.